When I sit down at the end of the week and I look through the price charts, review the price charts that I've looked through of the past week and look at new ones for the day, I have this conversation in my head, and the conversation is, I want to show what's important and not what's interesting. Now, the problem is what's interesting is really interesting to humans, right? So someone who would write or post 3 or 4 times a day on the stock market or investments, they're not showing you what's most important. They're showing you just, hey, look how interesting this is. And I get how interesting it is to the human brain to look at interesting things. But when I sit down, I want to show you what's most important for the week. And that often means showing you things that you may not think are interesting, but showing you what is most important to money. So with that, I sit down with that kind of the mantra in my head. What is most important? What is most important to people's money? And show them in a very clean, straightforward way. And so as I sit down and I think about this each day, each week, I look to what's most important. Hey everybody, this is RC Peck, and this is episode 328 of my weekend podcast where I talk about financial behavior and investment research kind of coming together. And the theme for this week, well, I have this Japanese theme flowing through my brain, so I'm going to talk about the Sumo Wrestler, at least in my image here, to talk about what the point of bringing this image up is what often catches your attention is not always what's most important, right? So if you look at this image of a very huge sumo wrestler-like person up against, say, a little 8-year-old, you say, well, that's really interesting. But what's most important is who you think, metaphorically, the 400-pound sumo wrestler is and who you think the 60-pound 8-year-old is. And if I were to say central banks and the stock market, I don't know, most people would probably think the central banks are the 400-pound sumo wrestler and the stock market just gets whipped around by the 400-pound sumo. And for some ways, I think that's true, right? The sumo wrestler, the central banks have huge influence over the short term, what markets do. Mario Draghi comes out and says, we're going to print 1 trillion euros this year, and we're going to take interest rates to a negative, kind of into the negative policy range. And Janet Yellen says, well, we're going to wait, or we may not increase interest rates, or we're watching things, or things are data dependent. And so they carry a lot of weight. Their opinions carry a lot of weight. But ultimately, hundreds of millions of humans across the planet investing their money, looking into the future and saying, is the future slightly better? Is the future slightly more scary? And from that, they ask themselves that question unconsciously. And through that, they determine which direction the stock market goes. That's what they determine. And of course, when Janet Yellen drops interest rates super duper low, economic term, they're super duper, yeah, it's probably going to make companies do more share buybacks in lieu of, say, dividends. But ultimately, the market sees this information and will still correct. So with that, I want to show you 3 price charts. And the reason these 3 price charts are important is because it shows you how this process actually happens, right? We humans want to think, well, you just kind of buy something low and sell it when it's high. But oftentimes, things are much messier than that. And if you just notice and allow things to be messy, then you're able to let your system actually work. And everyone is following a system. Most people just don't know the system they're following. So with that, I want to show you a price chart of the US dollar. It's been going sideways since the beginning of last year. Let's call it 16 months that it's been going sideways. And on the screen, you see a 200-day moving average, which has been falling, and it has been falling for about 2 months. Now, all things being equal, you don't want to see a 200-day moving average falling because it's an average price of the last 200 days. So if it's falling, that means whatever you're looking at is starting to go down. Now, the US dollar is in a sideways channel and has been for 16 months. It's processing information. It's processing interest rates. It's processing profitability of companies, and it's deciding what should we do? What should we do? Now, it's not doing it. Hundreds of millions of people across the world are figuring out, and there's huge influence by central banks on this, but what should it do? And if it breaks down, clearly breaks out to the downward side, that's going to put a lot of upward movement on commodities and precious metals. It's going to help them. But right now, it's kind of in a messy sideways process that it is correcting through time and not through price. And you've heard me say this before, that when people are like, oh my God, the dollar crashed, the dollar's crashing today, just pull up a price chart, zoom out, look at it and go, that's actually not what a crash looks like. That's just inside of a channel. And so right now, the US dollar is inside of a channel, figuring out whether it should break higher or lower based on the trend of the 200-day moving average. It is moving to the downside and right now looking to get weaker over time, but it is still in the channel. So we have to wait for this thing to make its final move. Now, as this has fallen this time, gold has moved up quite nicely, a total of 20% into a channel. And that's important because the dollar fell down here before and gold did not break up nicely and stay above that. So right now the dollar is figuring out what to do. It is correcting through time right now and not through price. The second price chart I want to show you is the S&P 500. This has been in a sideways channel for 24 months. Probably more harrowing than what the dollar is because most people don't look at the dollar. But right now we have the S&P 500 is in a sideways channel. The 200-day moving average is moving up right now. But if you're able to look at the screen, you can see that it's actually much lower than where it was the last time the S&P was at this exact same price. And the stock market is exactly where it was a year ago. Three very scary falls and 2 very nice rises. But at the end of the day, over the last 12 months, it hasn't really done that much. And until the S&P breaks out to the upside or the downside, we're in it's really a correction pattern. It is correcting through time. It is figuring out, can I go higher? Should I go higher? And Mario Draghi and Janet Yellen are really wanting this thing to go higher by printing more money and making interest rates even more negative. And the reason that would help stocks move higher is because it's going to make people more reluctant to hold cash and more reluctant to buy bonds. And look, there's only 4 major asset classes on this planet: stocks, bonds, currencies, and physical things. And physical things are broken down into real estate and commodities. So if one of those is kind of going away, the bond market and the currency market, because it's not paying anything to own those with negative interest rates, you're kind of left with physical assets and the stock market. And though I've never talked with Janet or Mario, it very well looks like that's what they want to do. But the stock market has not broken out into the upside yet, which is very interesting, which tells you how much the market actually wants to correct lower. So right now, the takeaway from this price chart is the stock market is correcting through time and not through price. Though it is gyrating up and down in about a 14% channel, it is still not decided what to do. And the last price chart of the 3 I want to show you is gold. Now, gold this year broke out of a 3-year down trend, and there's a line that you see where it broke above the downtrend. And the 200-day moving average is clearly moving higher, and it started moving higher at the end of January, the beginning of February. And that's really important because it's not easy to change the direction of the 200-day moving average, but in fact, that's what gold is doing. But like the US dollar and the S&P 500, gold's in a sideways channel too. A lot of things are correcting right now. Now, gold itself really hasn't done much in 2 months, but the 200-day moving average is still moving higher. So that tells you with this sideways correction with gold, that is a more positive sign if you're bullish on gold. And if you're bearish on the dollar, that's showing you from two price charts ago that it is getting more and more bearish. So right now we have 3 major asset classes on this planet that are all correcting through time and not price. So the question is, What is the takeaway, or what are the takeaways? So one of the takeaways is corrections happen two ways. One way is through time and things move sideways. This is very frustrating to people because they want to just have it be very clean. And of course, in hindsight, it is. And the other is through price. Now, all things being equal, you want to see things that are bottoming correct through time. If something is topping, that correction through time is more of a topping. So topping patterns and bottoming patterns can all oftentimes look the same. And we don't know until there's a clear break. But if something is bottoming, you want to see that correction through time. And if something's topping out, you'll often see it correcting through time. But one of the biggest takeaways is you have to have a strategy, and strategies matter, because looking at squiggly lines or looking at prices go up and down without the structure or the foundation of a strategy is going to it's going to greatly hurt your investment returns. And so strategies matter most, and strategies that look at price charts and use price charts and are able to eliminate a lot of the noise have helped people more over their lifetime, because we tend to let our lesser selves get involved in the game and hurt things. So the takeaway, 3 major asset classes are correcting through time. The US dollar and the S&P 500 could possibly be topping and correcting through time. And gold could possibly be bottoming or have bottomed and has broken out of the downtrend, but is in a 2-month sideways correction pattern. So the next 30 days is going to really influence a lot of portfolio construction going forward. I'm not saying any of those 3 will correct out of it, but as they do correct out of those sideways channels, it will give us a lot of influence for portfolio construction going forward. Hey guys, this is just another step in helping you protect your portfolio and protect your future. Until next time, this is RC Peck.